Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. Today, we're going to take a look at 3 things you can do in response to this year's market rout. First up, you could just do nothing. This chart shows the year-to-date performance of the top 5 technology equity ETFs investors searched for over the last month via our proprietary Trackstar data. Like the S&P 500 index and NASDAQ 100 composite, they're all off big time in 2022. Aside from their shared carnage, these ETFs have one other thing in common. They tend to bounce back, and bounce back hard after getting crushed. Outside of simply staying the course and doing nothing, your best bet would have been to buy more at each of these ETFs' March 2020 lows. Next up, you could become a stock picker. If you own ETFs, you own a portfolio of stocks you most likely don't have the time and money to own individually. So, you take the broad exposure an index or sector-specific ETF provides. This is one way to keep a diversified portfolio. During times of relative market tumult, it never hurts to dig into what the ETFs you own actually hold. For example, of QQQ's top 10 holdings, 3 stand out in terms of performance. Only Apple, PepsiCo, and Costco significantly outperformed their tracking index. You might consider taking individual positions in these stocks in reaction to the resilience, relatively speaking, they have displayed so far in 2022. Last but not least, you could go for more conservative income-producing equities. As part of today's ETF exercise, we looked at the ProShares S&P 500 Dividend Aristocrats ETF. This fund holds all of the market's dividend aristocrats, that is, companies who have increased their dividend payment every year for at least 25 consecutive years. As you move from specific tech subsectors to broad market indices to a relatively conservative income stock ETF, you still see red but a decreasing amount. If you're a long-term investor, it might be easier to stomach Noble's 6% year-to-date decline than, say, the double-digit drops of almost everything we're looking at today. Plus, you collect income along the way. While you don't want to fall for a dividend income trap, it is nice to know you can collect and reinvest cash from your investments during periods of poor stock price performance. The bottom line is this. During periods of market downside like we're experiencing now, the best investors refuse to panic. Instead, they calmly reassess. Today, we outlined one version of an ideal portfolio. It includes relatively risky investments and broad market barometers that tend to bounce back the most after getting a beatdown, best-of-breed stocks from that larger assortment, and a dividend-focused ETF that will typically not fall as hard but still bounce back with force. Use this time to consider the balance you've struck in your portfolio. Aim for a composition that looks something like this, but takes into account your time horizon, penchant for risk, and sector or individual stock preferences. That's all we have time for today on The Juice. Click follow and subscribe to The Juice email for your daily dose of market minerals.